Hi. So as we know, guys, in last two episodes, 2 to 3 episodes, what we have covered, it was the basics of real estate private equity, fund, then fund structure, and fund investment strategies. We have already covered, right? But now in this module, I would like to discuss in details about the different terms, right? What are the different terms, and then calculations, so that you should know how we can compute the value of a funds and all. And apart from that, we'll also try to understand other key aspect of this uh, real estate private equity fund, because definitely if you try to attend any interviews, real estate private equity interviews, you may see a lot of questions on calculations, accounting terms. So those terms that now I would like to target and discuss it. So please be there and try to attend this module, as it would be very very essential, because theoretical part you may cover from anywhere, but the calculations and all are like tough. So you need to attend this full module till the last moment to get the detailed insight about calculations. All right, so let's start with calculations. See, if I talk about, let's say, profitability ratios, like what are the profitability ratios, or how do we calculate profitability of real estate private equity funds or investment? So the first ratio is cap rate. So what is cap rate? Cap rate, it means, guys, capitalization rate, measure the rate of return on investment based on income generated from the property. Formula is net operating income divided by property value into 100. All right, if you just put it in the calculator, then you will get the exact cap rate. See, now we have a operating income, net operating income, annual income around, let's say, $80K, and the property value or purchase price means at what price you had purchased this assets. So you have a price, which is, that would be your property value, around let's say 1 million, and now you can compute the cap rate. So let's click on calculate. You have now capitalization rate. See, capitalization rate, which is something, as I already said, it's a basically which talks about income, how much income that you have generated from this particular property. So now in this context, guys, if you look at this, the 8% capitalization rate, which is in a strong return or solid investments with a balanced risk return profile, good for most real estate portfolios. Now if I talk about industry wide, the benchmarks or standard cap rates, see, 10% or plus would be like secondary markets, or for higher risk investments, you may see 6 to 10% would be suburban areas or moderate risk kind of the investment profiles. Then 4 to 6 for prime locations, and below 4% would be trophy assets or lowest risk. So yeah, this is how you can relate the cap rate. Cap rate is, guys, see, in the next module also we are going to discuss a lot of the metrics or a lot of details of private equity investments, would be like core investment. So please be there and try to understand each one. So now I'm sure you would have understood what is cap rate and how do we calculate. All right, then second one is cash on cash. Cash on cash is something, measured return on actual cash invested. Let's say we have invested, assume it in this context, we have invested $200K. Then how much cash that we have received, and which would be like pre-tax cash flow, right? So that is something required to calculate cash on cash. So cash on cash is nothing but it's a major return on actual cash invested. So let's calculate it, cash on cash. See, cash on cash, annual pre-tax pre-tax cash flow divided by total cash invested into 100. So that measures return on actual cash invested. Then what's included in cash and cash invested? Down payment, closing cost, initial repairs and improvements, and reserve and working capital. So all four component will be included in the cash invested part. Because let's say you purchase one property, then you paid a uh, let's say means at the initial level you paid a down payment of maybe 10%, then remaining value you paid, and then also you invested money for improvement or maintenance and other things. So that all comes under basically cash invested part, repaid and all right. So now let's say you have received cash of 20k from the investment property investment, and the total investment that you had invested at the time of acquisition of assets, it was 200k. So let's calculate return on cash on cash return, or return on invested property, you can say. So cash on cash return would be 10%. All right. So 10% will consider it as a strong return, good cash on cash return, or solid investment choice. Right. 10%, of course, beat the inflation and all. Now, if you ask me what would be the best or standard, returns, see, it should beat the inflation. Right. Let's say you have a three investment options. Stock market is offering 20%, but there would be high risk. And if you see same equivalent risk with the real estate, you should prefer to invest in the stock market. Let's say you have a bond investment where bond is offering 12% return on investment. Right now, if you compare 12% with this 10%, of course, the 12% is higher. So you should go for higher with a similar risk, if you find. So it means while taking investment decisions, we always compare with the other asset class. All right. But in this particular context, now if I talk about, cash on cash return, which is a 10% and which looks decent. Now, the next one is ROI. ROI, which talks about annual return on total investment, how much total investment return that we have received in that particular year. So we'll calculate in this way, like, and rate on investment. Right, rate on investment is nothing but it's an annual return, and simply if you want to calculate, put it like annual return divide with total investment into 100, so you can have ROI. All right. So now if you ask me, sir, what it defines, like ROI, what it defines? See, ROI defines like comprehensive measure including cash flow and appreciation. So now if I talk about the components which are required to calculate annual return, so net cash flow from operations, principal, the pay down, benefits, property appreciation, and tax benefit if applicable, all of this required to compute ROI. So let's calculate now. We have annual return. Let's say we have received 500k from the property investments, and against that 50k cash flow plus appreciation we have received from the property, and total investment it was 200k. So 2 lakhs in lakhs, if we calculate, 2 lakhs was invested and 50k that we have received. So let's calculate ROI. So ROI would be 25%. So 25%, of course, will treat like exceptional, outstanding total return including all benefits and excellent investment. But if you have, let's say, 10% or 5% would be poor, very, very poor. So sometime you would see negative ROI as well. If the, let's say, property hasn't performed and value has been depreciated, so you might see negative ROI also. All right. So this is how we calculate the profitability metrics of real estate investment. Now, if I talk about the risk assessment, to calculate the risk assessment of XYZ investments or real estate portfolio investment, we have three ratios. One is DSCR, which we call it as a debt service coverage ratio. Second one is LTV, loan to value. Third one is break even. So let's talk about risk assessment ratios and how do we calculate it. If I talk about debt service coverage ratio, how do we calculate? Net operating income that divide with annual debt service. How much income that we have received from the property, that you need to compare with annual debt service obligation. See, The DSCR measures property ability to cover debt payment. So this is very, very important. Let's say you have a property with 1 million and you have a debt of, let's say, 2 million. So this would be huge risky, right? So what it means, so your debt portion, it should lower if you compare with the property value. That's how we calculate, DSCR. If we talk about industry level, the standards, all right, DSCR range 1.5 plus would be very low, or we'll call it as an excellent. 1 to 5.15 would be again low, good. 1.0 to 1.25 moderate and acceptable. Below 1.0 would be highly risky. So let's calculate now to see in this particular context what would be DSCR. Let's say net operating income we have around 80k, and the debt we have, means debt on a property like principal plus debt, we have, let's say, 60k. Let's calculate it. So 1.33x. You have a decent net operating income against the debt of 60k. So 1.33, which is a debt service coverage ratio. This is a good coverage ratio. Now if I add, let's say, this one, so 100k you have a debt on investment, and you have against the debt you have only 80k net operating income. So let's calculate it. It's a poor, so it means 0.08x, which is a debt, you have a poor debt coverage ratio. It cannot cover debt payment and avoid this investment, right? Let's say you have 80k net operating income, and if I put like 80k as a debt you have on property, so let's calculate it. Debt service coverage ratio would be 1.0x. So what it means, you have 100%, let's say you have a 80k net income and against you have 80k debt to repay. So it means again it's a minimal coverage. What if, let's say, for XYZ months you have a less income, so you will of course default on a payment, so it's a risky, right? So that's how we calculate DSCR ratio. So DSCR, which talks about the capacity of repayment from that particular investment. So basically property should have to have repayment capacity of a debt. If not, then we should not invest. And in an interview also you might see questions around how do we calculate DSCR. All right, so take a note of it, guys. Then let's talk about LTV, loan to value calculator, or how do we calculate loan to value. See, loan to value we calculate like loan amount that we divide with property value into 100. So LTV measures loan risk relative to property value. All right, so we have some standard benchmark. Below 70% will consider it as a low risk and conservative financing. Then 70 to 80 would treat like a moderate risk and a standard commercial. 80 to 90% higher risk, aggressive financing. Above 90% high risk, require PMI and higher rates. All right, so let's calculate it. Let's say in this context we have around 80 100k let me just reduce the number, would be easy for reading. See, we have, let's say, loan amount of 80k, all right, on XYZ property, let's say, and property value which is at 100k. So let's calculate loan to value. So it means you have higher property value if you compare with loan amount, and this would be treated as a standard financing. What if, let's say, the property value which is at 120k and the loan amount which we have at 80k. So now in this context, see the property, this particular property or loan to value would be like conservative financing. So it means, so it's it's a conservative, it means the risk would be very low. Even if, let's say, the borrower would default on payment, still bank can seize property or fund can, let's say, seize property, sell it in market and recover the financing. So this is how basically, overall if we talk about, we treat. So in short, now if you ask me, sir, what is the purpose of LTV? So LTV is nothing but, so LTV which talks about the property's value, means how much is the property's value against the loan has already been taken. If the loan is, in this context, the loan is 80k and the property value is, let's say, 120k, so we are just comparing with loan amount what we have taken. All right. So now let's talk about then break even ratio. So break even ratio shows what percentage of income is needed to break it even. So we need a components to calculate, let's say, break even ratio, like operating expenses plus debt service divide by gross income into 100. All right. So if we talk about, let's say, break even ratio, if the break even ratio is 80%, 85%, that will treat as low risk, like strong cash flow. 85 to 90% would be moderate, 90 to 95 higher risk, and above 95 would be high risky, like negative cash flows. So let's calculate it. So let's say operating expenses of a property we have like 36k, annual debt service which is at a 60k, and gross operating income from the property which is at a 120k. So we have this, the numbers. Let's calculate it. So break even point which is at a 80%. So it means here in this context you would see low risk. Why? Because the property or investment has a strong cash flow. So you don't need to worry about it all. So now if I increase, let's say, the operating expenses, and look at this. Wow. It's 100%. So break even, which is at 100%. So it means 100% income, 100% expenses, no profit and loss. So you should avoid such investment. So where is, the break even, which is at 100%. So high risk, very tight margin, high probability of negative cash flow. Negative cash flow, it means now if I, let's say, increase in expenses would be negative cash flow. So in this case, very, very tight margin and we have a negative cash flow. So we should not invest in such a companies which has a tight break even point. 100 would be tight and below 100 would be, as we have discussed, strong, moderate, adequate kind of. This was all about risk assessment ratios, guys. Now let me talk about the valuation ratios. What are the valuation ratios? There are two valuation ratios which we consider while calculating the property values, and there are others as well, but in at least for in this particular module I would like to focus on this two. So let's talk about net operating income. See, net operating income which help us to get the valuation of a property as well. All right. See, net operating income, how do we calculate net operating income? Gross income minus vacancy loss minus operating expense, right? And this NOI, net operating income, excludes mortgage payments, depreciation and capital improvement. All right. So the component which is required to compute NOI, property taxes and insurance, property management fees, maintenance and repairs, utility if owner paid, and marketing and leasing cost. If we talk about industry standards, operating expenses typically ranges from 25 to 45 of gross rental income. So let's calculate now. We have a rental income 120k, vacancy rate 5%, and operating expense 36k. So let's calculate now. We have a net operating income at $78k. So now if we talk about gross income, $120 would be gross income in this context. Vacancy loss is 5%. Effective income, which is at 114 K. And if we talk about operating expenses, minus 36k, which we have. So net operating income, which is at a 78k. So in this case, the efficient operations, or the ratio which is at, the 30%. So it means this is well managed property with a strong net operating income. So property has, in short, lower expenses against the income. So property has a higher expense ratio, and this is what we'll call it as it's a good investment. Now if I increase, let's say, expense, if I increase expense, now look at this, we have a now negative operating income, and if we have a negative operating income, so it means we should not invest. So it's a significant operational issue may exist, so we should avoid such investment. So guys, in a property valuation or investments, it's a game of just income and expense. If the expenses are high, we should avoid. If the expenses are low and income is high, so it means we should invest in such a properties. All right. So now if we talk about GRM, gross rent multiplier. So gross rent multiplier, which talks about quick valuation tool for comparing properties. So how do we calculate? We need property price divide by gross monthly rent. Property price divide by gross monthly rent. So property price we have, let's say 100k, or I think it's a 1 million. It's a 1 million, and gross monthly rent we have, let's say 80k. So let's talk about GRM. So GRM, which is at 12.5, gross rent multiplier, which is at a 12.5. So it's a again fair value. If the GRM, which is at let's say in between, which is at 15%, we'll call it as a premium market, 12 to 15 appreciation market, 8 11 which is a balance market, and if it is lower, let's say 4 to 7, so cash flow market. So it means again it's excellent. So now if I reduce this gross monthly rent, see, if I reduce the income, gross rent multiplier would be higher. So higher is more dangerous, right? So it should lower. So now if I increase, look at this. Wow, it's a, I mean, decent one. If I increase the gross monthly income to compare with property price, that would be, it's a gross rent multiplier is, strong. So it means it's excellent value proposition or investment. All right. So yeah, these are the different, terms, or I would say may which are required, if you are looking for any private equity, real estate private equity accounting interview, and definitely, you may see the questions around it, and you should know this as well. All right. So I'm done with this module. So we'll cover the remaining portion in the another module. There would be a lot of things that I'm going to cover, like, in the same way, so that you can understand more in details. See, the purpose is to make you aware about all the, calculations and how does it works and all. All right. So let's connect in the another module, and we'll talk about the further part. So thank you very much for watching this. We'll see you in next episode. Thank you.